There are three approaches that we can use to measure the national income, which is the income approach, expenditure approach, and output approach. For the question we have chosen, we will solve it by using the expenditure approach. This approach provides a comprehensive view of economic activity and helps analyze the overall demand within an economy. We also have to calculate the real GDP at the market price in the current year. Change in the value of real GDP are independent of change in the general price level. Each change in the value of real GDP is due to a change in the quantity of goods and service produced.
Let's see the question for this topic. The question required to calculate gross domestic product (GDP) at market price. First, what is a gross domestic product? GDP is the standard measure of all final goods and services produced within a given a period of time by factor of production located within a country. GDP at market price is a value of final goods and services produced domestically by nationals and foreigners according to the price paid by consumers in a given year. The formula to calculate GDP MP is personal consumption expenditure plus with gross private domestic investment plus government expenditure plus export minus with import and plus inventory change. So the total value of GDP MP that we got from this question is 1,570 million ringgit. The second government question requires you to calculate gross domestic product (GDP) at the factor cost. GDP at the factor cost is the value of final goods and services produced domestically by nationals and foreigners according to the cost paid to factor of production in a given year. The formula of the GDP factor cost is equal to GDP at market price plus with the subsidy and minus indirect cost, which is 1,517 plus with 30 minus with 120. So the total value of gross domestic product at factor cost is 1,480 million ringgit.
For question A3, we have to calculate gross national product (GNP) at factor cost. GNP is the total of final goods and services that produced by a resident of a country during a period of time. GNP at factor cost, or GNPFC, is the value of final goods and services produced domestically and abroad by a citizen, factors according to the cost paid to the factor by consumer in a given time. So the formula of GNPFC is GDPFC plus factor income received from abroad minus factor income paid from abroad. 1,480 plus 12 minus 15. And we get 1,477 million ringgit. Question 4 is national income. National income is the total of individual income of a country population. For the national income formula, GNPFC minus depreciation. So 1,477 minus 50, and we got 1,427 million ringgit.
Last question for this topic is, if the current consumer price index is 120, calculate the gross domestic product (GDP) on market price. Real GDP is a macroeconomic statistic to measure the value of economic output adjusted to the price changes in a given year. It is expressed in the base year price index. The consumer price index refers to an index that measures the overall change in consumer price based on a market basket of goods and services. The solution for this question is real GDP at market price equal nominal GDP times base year price index divide current year price index. So after that, 1,570 times 100 divide 120, it will become RM 1,308.33 million.
In conclusion, GDP-MP amount 1,517 million is greater than GDP-FC with 1,418 because indirect tax are more than subsidy. If it's greater, it means that the total of goods and services including the indirect tax on product deducted with the subsidy is higher than the value of production. Also, GDP-FC is more higher than GNP-FC amount 1,477 million show that net factor income from abroad has a negative amount. It means foreign investment exceed domestic investment. Then the NPFC should be higher than national income because the NPFC includes depreciation or consumption of fixed capital. If the best year price index amount 100 is less than the current year price index, which is 120, it means that real GDP is less than nominal GDP. It also means that inflation when the general price level of goods and services produced in an economy has increased occur in the current year.